Mr. Mohit Gang, co-founder and CEO of Money Control. Mohit, thank you for joining us here on News 9. We were talking about IndusInd Bank numbers and what will be the key expectations. But any inferences that we can draw from the results of HDFC Bank?
Hi, Suyash and Amit. Good morning. Look, I don't think so. We can draw too much of inferences from HDFC Bank to results of any other bank per se, not just IndusInd Bank, because I think HDFC Bank is a classic case of a big size elephant now trying to make its move, right? So I think the issues of merger with HDFC Limited are still getting sorted out. The bank is in dire needs of deposit growth to fund its credit book, right? And I think those issues are very well known in the public domain. So there's nothing new which comes out from the domain of HDFC Bank. Yeah, the results were a bit upsetting on HDFC Bank, especially on the NIM side, and also to see a EPS decline in over 10 years, I think was a first new from an HDFC Bank kind of perspective. So that's kind of spooked the markets a little because a bank of that kind of quality with steady, stable results, giving that kind of an outlook was not really anticipated in the markets, right? Having said which, on the IndusInd Bank front, yes, I think the bank. For last 1 year, 2 year period has been looking extremely steady and robust on all parameters. Look, honestly, I think we're looking at an ROA of around 2% and an ROE of around 16.5 or around 17 odd percent thereof, which is a great trajectory for a bank of this size and order. It's been showing steady climb in its CASA mix also. I think they are aiming for a 45% kind of a CASA mix. We're trying to mobilize more of retail deposits and retail liabilities, which is actually boding well for the bank. And I think the numbers have already been put out by Amit. Markets is anticipating a good set of numbers, a steady set on NIM, fairly stable out there. So my sense is, I think once the entire dust settles around the banking pack, which should be a matter of few days now, and I think we should see a good uptick on IndusInd Bank. I think overall market sentiment plus the results or the performance of the bank is supporting a good number going forward.
Mohit, keeping to banks and the banking pact, now what we saw yesterday was foreign institutional investors pulling out almost 10.5 crores of rupees from the Indian markets, and most of them were from the banking pack, especially HDFC. If you see the stocks today, most of the banking packs are down or just hovering around the zero mark when it comes to earnings. Is it a time to get into this pack that these banks will not see a drop so much, so investors should rush to buy at these levels, or will the choppiness continue and they should wait for some time?
Amit, look, so we've been fairly bullish on the entire banking pack per se, right? And I think two sectors which we have been very bullish on, which I've mentioned in your shows previously also, in fact, not just now, but quarter back also, were banking and IT pack. Right. So I think we continue to be very bullish on that one. If India as a growth story has to persist, then I think everything will flow through the channels of banking sector, and not just private sector banks, but the PSU pack also. So PSU pack likes of SBI, Bank of Baroda, I think they're looking extremely healthy. The smaller ones like the Karnataka and Jammu and Kashmir Bank are again looking fairly robust out there. And on the private sector part, I think ICICI and Axis looks a little more stronger than the others in the pack. But having said which, I think the pack overall, which is the banking pack overall, I think once the dust, as I said, dust settles around this HDFC thing and the results thereof, I think we should expect a good set of numbers from all the other banks. So my sense is the pack should rebound fairly soon. If the momentum continues in the market, then we will see a good uptick on the entire pack coming back pretty soon.
All right, Mohit, also I want to spend some time on that 10,000 crore pullout from FIIs that we saw yesterday, as Amit mentioned. You know, it was not just the Indian markets that saw this big sell-off. Other emerging markets in Asia also saw a sell-off to the tune of somewhere around $5 billion. What do you think is leading to this, global sell-off in emerging market equities?
Suresh, yes, actually the numbers yesterday were startling. Honestly, I think 10,000 crore in cash outflow from FIIs is a massive, massive number, and not just India, but emerging market pack as a whole saw FII withdrawals, right? And I think that's just to do with one Fed statement which said someone in the Fed official mentioned that the interest rates might not come off as soon as it is anticipated. Plus, there was a higher than expected inflation data coming out of UK, and overall, the Chinese markets have also been reeling under extreme amount of pressure. If you see Hang Seng, even the Hong Kong market, which is the Hang Seng, it's been bleeding losses for quite some while now, right? So the overall data from China and Hong Kong wasn't very good, which is putting a good amount of pressure on the global demand per se. The US commentary coming out of Fed official wasn't very positive, again casting doubts on the rate cycle reversing. Though my sense is it is still intact, you will keep on hearing such comments on and off, but that led to a spike in the 10-year and the 2-year yields of the US bonds.
Right.
The 10-year bond is now almost back at around 4.1 odd percent, and the US 2-year is at around 4.36, 4.4 odd percent. So that kind of spiked up a lot, and which is what has spooked the markets or spooked the FIIs across the globe, and which is, I think, kind of led to that sharp pullback yesterday.
All right, and I also want to touch on China, and China's economy, of course, last year suffered one of its worst annual performances in more than 3 decades. As it was battling with this crippling property crisis, sluggish consumption, and the global turmoil in general. But looking at the Chinese markets, they have also taken a beating. So, valuation wise and from an FII standpoint, is China now more attractive than India, where valuations are looking a little stretched?
Look, Suresh, I think the Chinese market story is out there in the open. Honestly, I think the markets have been bleeding very badly for last 1 or 2 years put together, and it's showing no signs of recovering. Right, every day we get a flash of news which is worse than the previous day from the Chinese market. So, from an FII perspective, honestly, I understand what you're saying, and it's a fairly valid point that valuation-wise, Chinese markets are looking extremely attractive for the kind of growth that economy will still put out, right? Even though India as an economy will put out, let's say 7 odd percent kind of growth numbers, China will not be very far behind on that size, which is almost a 17 trillion kind of an economy. Putting out a growth number of 5.5% is not bad, to be very honest. But valuation wise, also it is looking extremely attractive. But I think the whole geopolitical scenario around the whole China story and the narrative is changing a bit, right? And my sense is that incremental flow, people aren't pulling out from Chinese market lock, stock, and barrel, but that incremental flow, some portion of that has started moving to other emerging markets, especially India and few other emerging economies, and which is kind of making an impact on China. My sense is FIS just don't look at valuations at times. They are also checking the entire geopolitical environment, and the way it is shaping out the narrative is not very favorable for China. So that's where I think the market is taking a beating. If that changes, my sense it will become a very, very attractive market opportunity to look at.
Mohit, is this buoyancy in China also because US and US financial officials and Chinese financial officials are meeting in Beijing this week? So that is giving impetus to the optimism in the Asian markets.
Not pretty sure of that, Amit. To be very honest, I'm not quite hopeful that a meeting between two financial officials might create a lot of thunder around the global markets. But yes, any outcome out there will be closely watched. But my sense is I'm not very hopeful of some dramatic changes in the market scenario overall because of that meeting.
And Mohit, before we let you go, what's your overall take on the markets? In a market like this, for a retail investor, would you recommend just sitting out and waiting for the dust to settle, or should we continue buying these dips?
Look, Suresh, if you're a long-term investor in the market with a 5-year plus kind of a horizon, and if you're betting big on the India story, which I am for sure betting on, right? There is no point of getting scared with these kind of corrections. Finally, it's a 2% cut, which we saw yesterday. Look, it's not
Right.
a whole big deal, right? And every year for last 43 years, markets have had a history of having at least a 10% correction once in a year. So I think every investor out there has to be mentally prepared for a 10 to 15% cut, which markets will definitely give you sometime in the year. Whether they give you now or they give you in the second half of the year is anyone's guess. But my sense is, as an investor, you can't get scared out of 2%, 3% kind of cuts, which is par for the course in these kind of markets which have run up so dramatically, right? So my sense is some froth needs to be taken off the market. Some craziness has to settle in. This entire frenzied environment around equities also need to cool off a little to taper down people's expectation from equity markets. And I think it is all very good and healthy. For long-term investors, there's nothing to be scared of. Honestly, I think the overall story and the broader outlook remains intact. And my sense is investors should just stay put and just ride this course.
All right, stay put and ride the course. That's the word coming in from Mohit Gang, sir. Always a pleasure speaking to you. Appreciate your time. Thank you for joining us here on News 9.